This is Luke Gromen from FFTT. Hope you are well. Hope you had a great weekend. The weather here was beautiful. We're getting into those late summer days. A little bit earlier sunsets, cooler nights. One of my favorite times of year. So hope you had a great weekend. Let's jump into the questions. Thank you as always for submitting them. Very thought-provoking. Really enjoy it. So really appreciate getting to do these interactions. So I'm going to jump right in. First question is from Paul. You recently tweeted about a trade-off between the strategies or options of the U.S. Treasury and the U.S. Department of Defense, if I got it correct. Can you discuss that further or correct me if I'm wrong? No, you've got it right. There are trade-offs. And what I was tweeting about is that we can either have a strong dollar or we can have a robust defense industrial base. We can't do both. Treasury wants the strong dollar to fund debt and past deficits. Strong dollar is good for Wall Street. It is good for those people in the Treasury export business historically, which is Washington, D.C. And it's bad for the middle working class and the U.S. defense industrial production base. And so the Department of Defense is flagging increasingly vocally that the 40 years of strong dollar have hollowed out the U.S. defense industrial base to such an extent that we cannot go to war without China and the components that China makes. And the problem, of course, is if our number one strategic competitor is China, that is a reason you can see very obviously why the Department of Defense wants to reshore, and reshoring the defense industrial base, full stop, will require a weaker dollar. Basically, defense industrial policy. Fed would need to either engage in yield curve control or print the deficits, whatever. Government spends the money, and the Fed's going to have to buy it. You basically have to run an inflationary industrial policy if you want to reshore the defense industrial base such that you are not dependent on, the DoD is not dependent on China in supply chains to the extent that it is. And that fundamental tension is something that I think is still very underappreciated in financial markets. So that's what I was tweeting about. From SFD, in your oil to gold ratio idea with 60 barrels for 1 ounce, and that's something I've talked about before. It's also something Zoltan Pozar has talked about. I understand how Russia, China, and India would sign up for this, but I don't understand why Saudi would. Could you explain the OPEC part of this idea? Thank you. This is a really important concept. The reason why OPEC would go along is because once peak cheap oil hits, and it with shale rolling over, it is. I would argue shale, the existence of shale means peak cheap oil era is here. But once shale rolls over in particular, in terms of production, in an era of high debt, oil prices will rise on average faster than the rate on debt that the U.S. government can afford to pay without going bankrupt. In other words, real rates on U.S. debt will be negative relative to the rate of inflation on oil on average. And so then your OPEC or Saudi choice is sell oil for treasuries, essentially, to oversimplify, treasuries whose value falls versus oil over time. And so basically you're going to have OPEC run down their oil production, swap it for paper, whose interest rate doesn't cover the rate of growth of oil inflation. And once their oil production depletes, then the paper that they hold in return for producing oil in the past will absolutely collapse against oil prices, right? Let's say Saudi Ghawar, the oil field, goes down 5 million barrels a day, goes 100% water cut, production collapses by some problem. You're going to take 5 million barrels a day off the oil market instantly. Oil is not going to 90 or 100 or 110. It's going to 150. It's going to 200. It's going to 250. And when oil does that, in that scenario, that is the Treasury portfolio of the former Gulf nations collapsing against oil. So as their oil production peaks, as we go into peak cheap oil, then they need to switch to a neutral reserve asset. Some asset that is not paper, that has an energy component, that has no counterparty risk, and whose face value can rise with the price of oil to maintain their the purchasing power of their reserves, their FX reserves, the stuff they earn, the surpluses they earn from selling oil, that maintains the purchasing power of their reserves in real terms, in oil terms. And that's only gold. And so basically what I'm saying is that there is a point where Saudi and OPEC, they all know the gig's up. It's a mathematical certainty. Peak cheap oil and the debt-backed system that we have with debt as high as it is, they don't mix. You have to make a switch to a neutral reserve asset with gold. That's why they would do it. And I also suspect they've got plenty of gold that we just don't know about. From AS, how do you think the widening gap between long-end developed market interest rates and gold resolves itself in the coming months? I think it resolves itself via a crisis, possibly an interest rate crisis, and then I think it resolves itself with more developing market QE and yield curve control. Up to yield curve control, I should say. I don't know that they go right to it. I think they desperately want to avoid yield curve control in the UK, Europe, and US. From Oscar, precious metals, the moving average 50-day, 200-day death cross is approaching in the gold graph. Are we about to fall off a cliff? I don't think we're about to fall off a cliff. Do I think you could see gold trade into the low 1800s in a crisis? Sure. To be blunt, I don't care. I'm not levered. I don't think anyone should own gold levered or in paper form. I think they should own gold bullion. And I think, as I've repeatedly said, in this environment where we are in peak cheap oil, we are in a global sovereign debt bubble that is bursting. I think trying to trade and time things will be extremely difficult for really most investors. Trying to trade gold to make a few bucks up and down will be extremely tricky. I would rather just own it unlevered and then go to the beach and wait for the end game. Is how I would prefer to play it metaphorically or literally. So, from Roland, Luke, what difference does it make if the Fed pivots or not if the government's going to deficit spend anyway? Deficit spending is going to surge inflation. Rates will correspondingly do so as well. Ultimately, it comes down to what the dollar does and what rates do, in my view. If the Fed or Treasury pivot, you get a weaker dollar. It is inflationary. It's good for asset prices. It's good for global growth. It's good for emerging markets. If you don't get a Fed or a Treasury pivot of sorts, then the deficit spending drives rates up, drives dollar up, and drives a global crisis that feeds on itself, as we're seeing do now, right? I think the game plan is choke out the world, force the capital back here by raising rates. I don't think people are appropriately weighting what is likely to happen, which is, as I've said, foreigners own $7.5 trillion in treasuries in aggregate, and they can and will sell them to raise dollars if the dollar rises on them and starts to squeeze them. They're not doing it out of a position of strength. Doesn't matter if you're long treasuries and they're dumping them to raise dollars. From Mark, your recent interview with Ameritrade did not mention the lag effects of rate hikes regarding Powell at Jackson Hole. If he doesn't raise rates, oil prices will rise and hence inflation. But you didn't say anything about the impact of the lagged effect of the hikes on the economy. Why? I was very focused on the lagged impacts of energy as it relates to that. So U.S. shale production would fall at about a 25 to 30% annualized clip, smooth, very front-end loaded, if they just stopped producing. That's just the geology of how it works. Global oil demand fell 4% annually in 1980 in a very severe recession. It fell 8% annually in 2020 when we basically shut down the global economy. Those were the two worst declines in oil demand, oil consumption globally, going back 70 years. Shale has been around 90% of global oil production growth over the past decade. So what I'm saying here, what consensus does not appear to understand, beyond the very short term, Powell's hikes, when paired with the SPR releases the Biden administration has engaged in over the last 16 to 18 months, they will cause oil supplies to fall much faster than oil demand will sustainably fall in a recession. And so oil prices are likely to be sticky, surprisingly, in sort of anything other than a collapse scenario or a shutdown scenario. And in fact, will probably rise because once supply starts falling faster than demand, prices go up. So to me, this points to Powell's victory, quote unquote, against inflation. To me, it all but guarantees that Powell's victory against inflation will be a Pyrrhic victory, barring an energy productivity miracle, because he chose the wrong strategy. You needed to inflate. You needed to inflate for longer. You needed to inflate long enough that U.S. oil production ramped up and that you brought oil prices down with a big bolus of new oil production in the United States, not by virtue of running down the SPR and raising rates. That was a short-term, penny-wise, pound-foolish strategy, and we are now into the pound-foolish strategy, or pound-foolish part of that movie. And then finally, from John, Luke, can you provide some current numbers that point to impending balance of payments problem-related doom? Like tax receipts versus interest or interest-like expenses, deficits versus global GDP growth, etc. Sure. So let's start with a couple. U.S. deficit, 8% of GDP. We cut deficits just back to 2. So that means we need to cut 6 points of GDP of spending instantly. That means GDP goes down 6%. Okay, great. In the Great Financial Crisis, GDP fell like 3 or 4 on an annualized basis. It was enough to nearly bring down the system. In 2020, GDP fell, if I'm not mistaken, 4 or 6, 7% on an annualized basis. With the economy shut down, it would have been enough to nearly bring down the system, required massive stimulus and massive, $600 billion a week in QE at one point. You can't cut 6 points of GDP without crashing the system. Okay, so that's number one. Number two, trailing 3-month tax receipts down 20% year over year through May. That's only happened a few other times in history. 1Q09, 2Q02, and then I think right around 9/11. So every time in recessions. Now, California, some timing stuff there. Even if you assume California, if you normalize for California, you're still probably down 8 to 10% year over year in tax receipts. Fiscal first half of this year, so that is 4Q22, 1Q23 calendar. U.S. true interest expense in the fiscal one half was above Treasury receipts already before the big drop off in tax receipts in April and May, and before the major reset in interest expense goes higher. And so after just 6 months of interest rate hikes, U.S. government receipts were not covering interest expense on a full year basis. So either the U.S. government defaults on entitlements and Treasury spending, or rates rise globally to attract the capital, which again is only going to touch off the debt spiral. Foreigners have $7.5 trillion to sell. Dollar goes up. They sell more treasuries to get dollars. Rates go up. Interest expense goes up. Deficits go up. Receipts go down. Dollar goes up. More foreigners sell more treasuries. Wash, rinse, repeat. So again, we've already crossed the Rubicon here. Treasury receipts being below true interest expense. I don't, to me, buying long-term debt of a country who can't cover their true interest expense unless the central bank prints it, that is a trade that is picking up pennies in front of a steamroller. I don't think you do well over time buying the long-term sovereign debt of countries who can't cover their true interest expense out of tax receipts, at least not doing well on a real basis. You might do fine if the government, if the Fed turns into a yield curve control. So that is just some of the dynamics why I think we are in the, why we're getting down to brass tacks, as they say, in terms of the global sovereign debt crisis that we've been describing in real time all these quarters and years. So with that, I'm going to jump for today. As always, thank you very much for joining me. If you want more information about our different product offerings, if you like these updates, check out FFTT-treerings.com, 10 most interesting things. Brief synopsis about what grabbed our attention about it, how it changed how we were thinking about the world, or how it confirmed how we were thinking about the world previously. An ongoing story really every week. So with that, I'm going to sign off. Everybody have a great rest of the week. I look forward to chatting with you all soon. Take care, everyone.